What's going on, everybody, and welcome back to another episode of the Midterm Rental Show. I'm your host, Kramer, and I am extremely excited for this episode. I know I kind of say that a lot, and it's because I'm excited about a lot of episodes, and this is no exception. Because today, what we're going to be talking about is financing for midterm rentals. Now, I know it might not sound super sexy or super exciting, but I can promise you it is one of the most commonly asked questions I get when it comes to midterm rentals. So, what we're going to be covering is essentially the different ways to finance a property. Hey guys, it's Bailey here. Real quick, I'm tuning in because I just edited the entire podcast episode. And as I was listening through the entire thing, it was extremely valuable. But I know a lot of you guys don't just like to listen to things. You guys actually want something either physical or tangible that you guys can actually use to help you. So what I did is I essentially turned all the information that I talked about here on this podcast episode into a completely free downloadable worksheet. So if you guys gain a lot of value from this episode and just want more of a visual to actually go along with this, you can grab it down below. It's completely free. It's basically just going to take what we talked about in this episode and give you a way better visual understanding of everything. So if you, again, find value out of this episode and you're like, wow, this is great, I'd love something like that, grab it down below. Again, completely free. All right, enjoy. So the first chunk, we're going to be talking about long-term financing. So this is going to be DSCR and conventional loans. And if you're like, Bailey, what are you even saying? Don't worry. I'm going to be breaking it down as simply as humanly possible. The second thing we're going to be talking about is short-term loans. So this is basically private money versus hard money. And then number three, we're going to be talking about how to finance furniture for your midterm rentals. So I know it's a lot. I've kind of designed this episode to where I'm going to basically just do what I do, talking to a friend, a sibling about this who is brand new in real estate. So I'm going to try my best to dumb this down. That's probably the wrong way to say it, but simplify this down as much as possible so that you can understand it as clear as you can. So without further ado, let's go ahead and jump in. Okay. So when you are wanting to buy a property, I do not recommend you use just cash and you put 100% down on a property, because then you don't have leverage and all that stuff. And most people don't have, hundreds and hundreds and hundreds of thousands of dollars laying around to just buy properties cash. So you need to use some sort of financing, AKA you need to get a mortgage on the properties. Now with midterm rentals, and some of this stuff is rental property specific, no matter what strategy you're using, but I'm going to talk very specifically about midterm rentals. So when you are getting a mortgage on a midterm rental, there's basically two different loan types you can get, two different mortgage types, if you will. The first one is a conventional loan, okay? And then the second is a DSCR loan, which stands for debt service coverage ratio loan. You don't have to memorize it. I'm going to be breaking it down really simply for you. So let's start with the conventional loan. A conventional loan is, I would say, more so thought as your very traditional mortgage. So if you're going to get a mortgage for a house, for example, if you've ever done that before, you'll know that the underwriters, the people who are, you're applying to a mortgage from, they're going to be asking you not only a lot of questions, but they're going to be collecting a lot of documents. They want to see your work history. They want to see tax returns. They want to see bank statements. They want to see just like, they're going to dive into your life and your financial life, shall I say, and they're going to basically determine if you make enough money to cover that mortgage. Okay. That's what the conventional loan in the simplest term is all about. It's basically, can you as a person handle this mortgage? That's what they're trying to look at point blank. So if your credit score is not good enough, if your income isn't good enough, you're not going to get approved for that loan. So one other thing I want to mention on the conventional loan side here is this is more so for people who have a W-2 job and have had that job for, over a year, that you can show consistent income. And this is for people with good credit scores, because again, the bank wants to make sure that you can actually handle this mortgage payment every single month. So again, quick recap there. You need to have a W-2 job typically and a good credit score to qualify for a conventional loan. Now, some positives of the conventional loan is usually the rates or the interest rates you're going to get are very competitive with any other mortgage rate you can get out there. So I'd say for the best rate, conventional loans are great. Okay, for the best rate, conventional loans are great. That rhymes. I love it. Now, I would say the biggest downside to conventional loans is two things. Number one, not everyone's going to qualify. I personally do not qualify for most conventional loans, even though I have a bunch of properties, because I don't have a W-2 income. So if you don't have a W-2 income either, it's going to be very hard to qualify. Don't worry. There's another option for you we'll talk about. But another big limitation to the conventional loan is there is a limit to how many conventional loans you can actually get. So typically the number is 10. You can only get 10 conventional loans on a rental property. So if you don't have any rental properties, don't worry about it. You can still get 10 under a conventional loan. But for me, for example, I'd basically be maxing out if I went the conventional route. And once you do tap out, then what you can do is go the DSCR route, which we will talk about. So the DSCR route, again, it stands for debt service coverage ratio, has some similarities and some differences to conventional loans. So here's what it is in a nutshell. Remember how I told you in a conventional loan, they're going to look at you, your W-2 income. They're going to make sure that you personally can actually handle this debt. Well, DSCR loans are different in the way that they're really looking at the property itself. And they're saying, this is a rental property. How much is this rental property going to make? And they run the numbers based on comparable rents. And they're going to say, okay, let's just say this property is going to make $1,000 per month. And then they look at the mortgage that they're going to issue to you. And they're going to say, okay, well, the mortgage payment is going to be $600 a month. So there's $400 of spread in there, which is enough for the lender to be comfortable to give you that loan. Now, there's certain DSCR ratios, and I'm not going to get too deep into that because that's probably too advanced for this podcast. But essentially, what it means in a nutshell is if the rent amount is $1,000 per month that you can get on a property, but the mortgage is going to be $900, that $100 spread isn't big enough to get a loan for that property. So there needs to be a big enough spread for that to actually qualify for a DSCR loan. So also similar though to a conventional loan, they're still going to look at your credit score, and typically a 680 credit score or above is what you're going to want for a DSCR loan. Now, obviously the higher the score, the better terms you're going to get, aka the lower interest rate you're going to get, but you typically need at least a 680 credit score for a DSCR loan. Another thing with this type of loan is they are not going to look at your employment history. So if you are self-employed, unemployed, you name it, it doesn't matter for a DSCR loan. As long as you have a good enough credit score, which is basically 680 or above, you have a property that is going to rent out for much more than the mortgage. And then number three, there are some reserve requirements. And this also plays into account with conventional loans. But for a DSCR loan specifically, they're going to want you to typically pay the taxes and insurance up front for the entire year, sometimes 6 months, sometimes a year, but I'm just going to say a year to make it simple. And they're going to also want you to have enough money in reserves to cover the mortgage payment for about 6 months. So you do need to have some cash on hand if you're going to do a DSCR loan, because your down payment is going to be a little bit more when you factor in prepaying insurance, prepaying some taxes, and having enough money in your bank account for reserves. So unlike conventional loans, there's no limit to how many DSCR loans you can get. You can get as many DSCR loans as you can possibly handle personally. So there's no limit, which is really cool. The one big downside of DSCR loans that I would say is they have something called a prepayment penalty. Okay? So what this means is if you either sell the property or refinance the property within the penalty window, you owe a fee. So very simply put, there's really two different types of prepayment penalties that I'll break down. The first one is a 5-year prepayment penalty. What this means is if you sell or refinance the property within 5 years of buying the property, you're going to owe a percentage of the existing mortgage balance as a penalty. So let's say, for simple math, you have a $100,000 loan balance. That's your mortgage on the property. And you decide after 6 months of owning the property, you know what? I need to get rid of this property for whatever reason. I want to sell this property. So you sell the property for whatever amount of money. That has no impact on this. What you're going to owe is not only the money for your existing mortgage balance, of course, but you're going to owe a penalty. That penalty would be, if you sell it in the first year of owning it, 5% of the loan balance. So if the loan balance is $100,000, you're going to owe $5,000 as a penalty for essentially prepaying the loan early. Because essentially these lenders, yes, they make money up front from the loan, but they're really counting on you to pay this loan over a, it's a 30-year loan. So they don't necessarily need you to have that mortgage for 30 years, but they're going to make more money on interest the longer you hold the loan. So that's why they have a penalty. So the first year is a 5% penalty. If you sold the property in the second year, it'd be a 4% penalty. Third year, 3%. So it's a step down. So 5, 4, 3, 2, 1. So if you sell it in the fifth year, it's only a 1% penalty. If you sell it in the sixth year or beyond, there's no penalty for selling it or refinancing it. So again, just a way for the lenders to protect themselves. So I mentioned there's two different types of prepayment penalties. The first one is a 5-year step down, which goes 5%, 4%, 3%, 2%, 1% over those 5 years. The second type of prepayment penalty is a 3-2-1 step down, which would be the first year, if you sold it or refinanced it, you'd owe a 3% penalty. Second year, 2%. Third year, 1%. Fourth year and beyond, no penalty. So depending on what you choose, which prepayment penalty option, the rates and terms are going to change slightly. Personally speaking, I like a 3-2-1 step down just because I think I can say confidently I'll hold it for 3 years, but anything like 4 or 5 years, I don't want to commit myself. Also, too, if the interest rates go down and I want to refinance, I don't want to have to owe a penalty to do so. So I prefer a shorter prepayment penalty, but I do have some loans with 5-year step downs, and I do have some with 3 years. So I wouldn't say there's a right or wrong. It's really up to you, but that's kind of the difference there. Now, one other thing I want to break down when it comes to DSCR loans versus conventional loans is the different term options you can get. Now, you can pretty much get the same option no matter which option you do, whether it's DSCR or conventional, but this is just something to be aware of that I wanted to include in this financing masterclass. So the first and most standard option is a 30-year mortgage. This is most commonly known because most homeowners have a 30-year mortgage on their property. This will allow you to have the smallest monthly payment because the whole loan balance is divided by 30 years plus all the interest. So it's nice because you'll have the smallest monthly payment. The only downside to a 30-year mortgage is going to be that you're going to pay more interest than if you did, let's just say, a 15-year loan. But if you did a 15-year loan, then your mortgage payments are going to be higher, but you're going to pay less interest over time, and the loan will be over quicker. So that's up to you. I do 30-year mortgages personally because I just like to have a lower payment and have more options. But again, just wanted to mention that. The second thing when it comes to these loan terms is you could either pick a 30-year mortgage, right, or 15-year, or a long length like that, or you can do something called an adjustable rate mortgage, also known as an ARM, ARM, adjustable rate mortgage. So what this means is your interest rate is locked in for a certain amount of time, okay? So that's actually one thing I want to backpedal real quick. For a 30-year mortgage or even a 15-year mortgage, your interest rate is locked in for the entire period. So if you get a 5% rate, 6% rate, whatever it is, you're locked in for all 30 years. When you have an ARM, an adjustable rate mortgage, your interest rate is only locked in for a certain period of time. So there's what's called like a 3-year ARM, a 5-year ARM, a 7-year ARM. Basically means whatever the number is on the front, a 3-year, a 5-year, a 7-year, that's how many years your interest rate is locked in. So I currently actually have one adjustable rate mortgage right now, and I'm not really a big fan. It was a long story of why I had to essentially get it, but the downside to this loan. So I have a 5-year ARM, and the interest rate's fixed for 5 years. Now, after that 5-year period, what happens is the interest rate is going to change. And that change is going to be whatever the current market rate interest rate is. So if interest rates spike and go really high, your new monthly mortgage payment is going to increase a lot. Now, is there a chance that the interest rates go down lower than what you had it before? Yes, it's possible. But you only can get that benefit for as long as the interest rate is low. But once it jumps again, whether that's in a year, 2 years, 5 years, whatever, your monthly mortgage payment is going to change consistently. So not a big fan of ARMs. If you can lock in the 30-year mortgage, I think it's the best for stability purposes, although I think ARMs do have their place here and there. Okay, that's it on DSCR versus conventional loans. Now let's jump to the more short-term loans, which is really going to be your two options being hard money versus private money. So first, let's break down what is hard money and what is private money and what is it for, and literally every detail or question you could think of. So let's first talk about when you would use either of these options. So there's really two main options that come to mind and that I've used them for. The first option would be if you were doing what's known as the BRRRR strategy. This is where you're buying a property, you're renovating it, you're refinancing it, you're renting it out, and then you're repeating the process. AKA, or another way to say it if you're not familiar with the BRRRR strategy, is let's just say you can't qualify for a DSCR loan or conventional loan because for either of those loan types, you can't have the property like be unlivable. So if the property isn't in like livable condition and you want to put a lot of work into the property, a lot of money to renovate the property, you're going to need a short-term loan until you can get the property looking beautiful and rent it out. And then you can refinance into a DSCR or conventional loan. But in the period of time where you need to renovate the property, you can use either a hard money loan or a private money loan. So let's talk about what they are because they're very similar, but essentially, we're going to break this down. They are loans that are typically issued for 1 year or less. So you essentially have 1 year to pay these loans back. Now, typically, you can pay these off faster depending on the project, but 1 year is very typical for a loan term. Now, unlike a DSCR loan, there is no prepayment penalty. I borrowed money using a hard money and private money loan that has gone as little as 3 months, which is totally cool. I can pay those back. There's no prepayment penalties. That's it. So hard money and private money, what these require is typically a interest payment every month. So let's just say you borrow $100,000 for a property and you're paying a lender 12% interest on their money. Now, let me pause on that. That reminds me, the interest rates for a hard money and private money loan will be higher than a traditional DSCR or conventional loan. Typically, I wouldn't say like double is the rule of thumb, but I guess it kind of is because today you can get a conventional DSCR loan around 6%. You can get a hard money or private money around 12%. So maybe rough rule of thumb, I'll say double. But the reason why they're more expensive or the interest rate is double is because number one, they're a shorter term. It's only a year or less, or sometimes even a couple months. Number two, there's technically more risk to the lender if you're doing a hard money or private money loan, because at the end of the day, you're renovating the property, things can go wrong, that whole bit. So that's why the interest rates are higher. But those monthly payments are going to be just interest. So you're not paying down the loan and you're not building equity in those loans. You're just paying interest. So let's just say again, $100,000 loan, 12% interest. That means your interest payment every month would be $1,000. So $1,000 goes straight to the lender and your essential mortgage balance is still $100,000 because you're not paying down any principal. You're not building equity through a private money or hard money lender. Okay, so let me take a step back and I'm going to define the difference between hard money and private money. So a hard money lender is essentially a company. So a hard money lender is like a big corporate company, right? With big corporate companies, they have hard rules. They're not as flexible as smaller companies. They're just very I don't know if rigid is the right word, but they're very orderly and standardized. So they don't have a lot of wiggle room. They have their rules and you can't really bend them much. But they do have a lot of money behind them since they are large companies. So if you wanted to get a hard money loan, for example, and you go to a hard money company, they're going to give you their terms and that's it. It's either take it or leave it. There's no negotiating. There's nothing. Those are the rules. And that works out for a lot of people because there's a lot of great hard money companies and I've used them before. I even own a company called Investor First Capital that I can help you get a hard money or a DSCR loan. But hard money is great. But what's even better, truthfully, and I don't even make money on this, is private money. So private money is a very similar concept. The only difference is private money typically comes from either a small business, like a small lender, or a family member, a friend, a coworker, somebody like that. Now, the beauty of private money is you can typically get better terms and better interest rates than these hard money lenders. The reason being is because hard money lenders know real estate like the back of their hand. They understand the risks. They are very sophisticated, if you will. Whereas private money lenders, not the only reason, but the main reason why someone would lend you money as a private money lender is because they trust you. They don't know anything about real estate. And again, not to say that no private money lender does. I'm just generalizing here. But they essentially say, Bailey, whatever your name is, I trust you. And I think if you can give me a good interest rate on my money, I'll be happy. So you can negotiate the terms. You can tell them, hey, I want 100% financing. I want this interest rate. And they still have to agree to it. You still have to make it reasonable, but there's just more flexibility. They're not as rigid as a hard money lender. So to take a step back, if you use a hard money or private money lender, there's going to be two components to it. The first is the money for the down payment, and the second is money for the renovations. So how hard money lenders work is they typically require you to bring, depending on your experience, between 0% down for the down payment or up to 20%. So again, let's use a property that costs $100,000. If you're brand new, you're going to have to bring probably 20% down, which is going to be $20,000 in that case. If you're really experienced, you can bring zero and the hard money lender will cover the whole thing. So that's on the purchase side for hard money. Now on private money for the purchase side, it's really whatever you negotiate. If you're somebody who wants to bring on a lender that will give you 100%, great. You could be brand new to do that. There's no requirements for the private money side. There are some more strict terms for the hard money. On the renovation side, what a hard money lender will do is they'll say, for example, Bailey, you front the money for the renovations, and then once you do the renovations, fill out this form, and then we'll reimburse you. So what will happen is you'll do the renovations. You'll put, let's say, $15,000 worth of renovations on a credit card. You can use cash, however you want to do it. And then what's going to happen then is you're going to fill out a form to the hard money lender. Hey, I just spent 15 grand. This much went to flooring. This much went there. They're going to give them your receipts and they're going to send you $15,000 to reimburse you. And then you're going to do it again. Hey, spend another $10,000 on the roof. You're going to go back to the hard money company and say, hey, I just spent 10 grand. Can you reimburse me? They're going to say yes. And the process goes on and on. This is so that the hard money lender is protected, very simply put. But with private money, this is different because you negotiate the terms. So if you don't want to do that structure, then negotiate not to do that structure. What I do with my private money lenders is I'll say, hey, if you want to be my private money lender, here are the terms. I'm going to give you a set interest rate. Typically 12% is what I shoot for, but yes. So 12% is what I shoot for. But in exchange, I want them to cover all the purchases, the entire purchase price, and I want them to send me all the money for the renovations all up front. Now, not every private money lender is going to do this because hypothetically speaking, I could just run off with their money and they'd be screwed. But private money lenders, the ones I use at least, they trust me and know me well enough to know that I'm not going to do that. So that's what I require from the private money side. It gives me more flexibility. I don't have to front any money. It's just very seamless. So I mentioned the interest rates are going to be probably a little bit more on a hard money loan. The other downside of a hard money loan is what's called points. So this is another way for lenders to make money. And I think it's totally valid. I don't think it's like a greedy or bad thing, but it is something to be aware of. So hard money lenders will not only charge you an interest rate, so let's just say 12%, but they're going to charge you, essentially it's a fee for doing business with them. And that fee could be between 1 to 3 points. Now, what is a point? It's essentially just a percent. So 1 to 3%. Let's just say in this example, $100,000 loan and you're paying 12% interest. So you owe them $1,000 a month. That's what that correlates to. On top of that though, they're going to charge you, let's just say 1 point up front and then 1 point once you refinance it or sell it. So that's going to be $1,000 up front as a fee and then $1,000 once you refinance it or sell it. Again, so they're not only making 12% on the loan, but they're also making $2,000, $1,000 on the front, $1,000 on the back. I know it's kind of confusing. You might have to listen to that a couple times, but that is another thing to know about hard money lenders. Okay, last note here on hard money lenders is requirements. So they're very similar to DSCR loans in the fact that they want the deal to make sense. Yes, they're going to look at your credit score, and yes, they're going to make sure you have enough cash in the bank, but they really want to know, does this property make sense financially? Once you renovate it, is it going to be worth more than what you have put into it? So they're very just like logical based, mathematical based. They want to make sure that the deal makes sense. Whereas private money lenders, again, they're basically kind of going off of trust for the most part. So they're just trusting you that you're going to pay them and everything's going to be okay. Now, with both options, you're typically guaranteeing the loan, meaning you owe them the money back no matter what. So even if you mess up on the real estate side of things and the property doesn't appraise for what you thought it was going to appraise for, you're going to owe the lenders the money one way or another. And that is, some people look at that as like a risk to real estate. And I would say, yeah, that is a risk, but the reward is so great if you can actually do it. And that's why everyone doesn't do it. I saw some stat that like 6 to 7% of people in the US own real estate. Yeah, because it's so much easier to go online, press buy on a stock, and now you own a stock. Real estate is a lot more complicated, but again, the reward is a lot higher. So that is why I do it. And of course, the first time you do one of these loans, it's going to be a little stressful. It's going to be a little hard, all that good stuff. But once you get the hang of it, you don't really even think twice about it. So that's kind of the breakdown of the hard money versus private money. I now want to go to a bonus section where I'm talking about how to finance furniture for a midterm rental. So there's infinite ways to do anything, but I'll tell you a couple ways that you can do it and ways that I've done it in the past. Number one, you can just pay for it out of your bank account. So very simply, if you just have money sitting around and you want to just spend 10 grand on furniture, you can do that. There's nothing wrong with that at all. I think that is the safest way to go because you just buy the furniture, that's it. But number two adds a little bit more leverage to it. And this is by putting the furniture on a 0% interest credit card. So what this means is you're going to find a credit card. This could be, for example, I've used like the Amex Blue Business Plus card. I can't even think of the different credit cards I've used. I'll link some down below that I like, that I actually use. I know Wells Fargo has a good one. There's several, and you can just look up best 0% interest credit cards. But anyways, these are really good because it gives you typically 12 to 18 months to actually pay off all the furniture. So instead of coming out of pocket 10 grand, you can put it all on a credit card and just pay. There's a certain amount you have to pay each month to still keep up with it, but it's a very low amount. And this just allows you to add a little bit more leverage and typically still earn credit card points, which is pretty cool. Obviously, the big risk to this is if you don't pay off the credit card, the interest is insanely high. So this is really a strategy for, more savvy people that can 100% pay off the credit card. I remember I did this strategy when I was furnishing my triplex. I put it all on a 0% interest credit card and I paid it off over like however long, a year that they gave me. And it worked out. I paid it all on time. It was great. But if I didn't pay that on time, that would have really bit me financially. And then, of course, the third way, you could use like a private money lender, someone who like lends you money for the furnishings. I don't know how much it's worth it to pay like a high interest rate on furniture. So I don't really think it'd be worth it unless if you have a friend or family member who literally has money sitting in their checking account that is earning 0 and you can give them like 5% of their money, then yeah, I think that would be worth it. But I probably wouldn't pay more than 5 or 6% interest to borrow money for furniture. So yeah, I think cash is just easier, especially you're already taking a lot of loans and mortgages for the purchasing of the property. So I think it's totally valid if you want to just pay for the furniture yourself. So that is the masterclass on financing midterm rentals. I know I said a lot of words, probably a lot of confusing things. This might be an episode where you have to replay it, or you might have questions. And if you do, I recommend you direct message me on Instagram. I know several of you guys have already messaged me, and I've had great conversations with you guys, and I love it. So if you guys have questions about anything I said on this episode, please reach out. I'm here to help you guys on your midterm rental journey. Thank you for tuning in, and I will see you on the next one. Peace.